What impacts are tariffs and lower interest rates having on high-yield fixed income? Hi, I'm Michael Chang. In this video, we'll discuss how our team is thinking about tariffs, the effects we see from rate cuts, and how the high-yield market is changing. I'll also provide guidance on how to incorporate the new Vanguard high-yield active ETF into your clients' portfolios. Tariffs are a great example of an issue that really highlights the value of both active management in high yield, as well as the need for really deep specialization and experience. Topics like tariffs are quite complex. And so when we think about the impacts on the high yield market, it's really different. It's different across different issuers and different industry sectors. There are both indirect and direct impacts, and there are going to be winners and losers. And so part of the opportunity that we've had in high yield over the past several months has really been analyzing the funnel impacts across sectors, across issuers, and trying to identify opportunities that we think are mispriced in the market. Now, a great example of that is the retail sector. The retail sector is one of those sectors that was, from a valuation perspective, most impacted by some of the headlines that initially came out in April. And so one of the biggest opportunities that our team had this year is really sifting through both the fundamental impacts within that sector across different issuers, but also looking at how that was priced in the market. And some of the dislocations that we saw in retail really gave us the opportunity to find some really attractive opportunities in a sector that we previously didn't think there were opportunities in. Tariffs are one of those topics that create uncertainty in the market. And with uncertainty creates volatility. And it's in those times of volatility where, as an active manager, we can really capitalize on those opportunities that we think are mispriced in the market. In general, lower interest rates are good for the high yield market. Lower interest rates means easier access to the capital markets for issuers that need that access. It also results in lower refinancing costs for many of these issuers when they do come. We saw this in September with close to $60 billion of issuance, which was close to a record. Most of that issuance, more than 75%, was for refinancing purposes, and it really allowed high-yield issuers to both refinance their debt as well as term out their maturities at lower interest rates. One of the more important questions in terms of lower rates is why? Why are rates going lower? In the past, lower rates have often been associated with weaker economic environments, potential recession. And recession is really the biggest risk to high yield. Recessions usually result in higher default rates, higher credit losses. And so while it is not our base case, to be clear, it is one of those scenarios that we're keeping a very close eye on. We also see a high yield market today that's undergone some pretty significant structural changes over the last 15 years from a positive perspective. And therefore, we actually expect the high yield market potentially to behave a little bit differently, hold up a little bit better in the event we do come across weaker economic times. The high yield market today is not the high yield market of old. It's a higher quality market. Just to put a couple numbers to that, the proportion of the high yield market today that's higher quality, BB rated, is almost 50% of the market. It's up 15 percentage points relative to where it was 15 years ago. And on the flip side, the proportion of the high yield market today that's lower quality or CCC rated is closer to 10%. And that's 15 percentage points lower than where it was 15 years ago. It's not that the type of aggressive behavior that we would normally see at this point in the cycle hasn't happened. It just hasn't happened in the high yield market. We've seen a rise in alternative financing markets for that type of more aggressive activity. Markets such as the syndicated bank loan market and the private credit market have really taken the brunt of some of this more aggressive issuance. The implications for the high yield market are really positive. It's positive from the perspective of potentially lower default rates relative to what we've seen in its history. And it's also positive from the perspective of lower credit losses. The other implication in terms of the high yield market is really around spreads. Spreads today look pretty tight, but given the higher quality aspect of the high yield market, they could potentially go even tighter. I couldn't be more excited to be able to offer this high yield ETF today, in part because when you think about the high yield market, it offers tremendous income potential today, while also offering longer term the ability to generate not just income, but also total returns and diversification benefits to your clients' portfolios. All the while being able to do so in a low-cost manner that allows your clients to keep more of the income that we are generating for them. What this new ETF also provides is the ability for your clients to access the full opportunity set within the high yield market, while also being able to access the full capabilities of our team. Finally, we are big believers in active management and high yield. The high yield market is one that is still relatively inefficient and a market that still offers tremendous opportunities to add alpha on behalf of your clients' portfolios. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.